Hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Well, if you look at the global cues, mixed picture as we've been seeing over the last few days. Wall Street is coming off a positive session despite Trump's tariff threats. Asian markets were mixed, but a lot of data as well to digest when it comes to the Asian region, right? Because China data came out. GDP figures were above expectations, IIP figures were above expectations, but retail sales were a miss. So yes, on the industrial side, things are looking good for China, but it's the consumer sentiment that has taken a hit. In terms of our data as well, we had the CPI figures for June that's come in at a 6-year low, 2.1% or so. So yes, that's something that we will take heart from. And we also have the US CPI data that will be coming out today, and that becomes crucial because tariff impact will be seen, and the street is keenly waiting for the US CPI data as well. It is expected to edge up to 2.7% or so according to an estimate vis-a-vis 2.4% last year. So on a year-on-year basis, we can see an uptick in the CPI data for US. So that's key to watch. Lots to watch out for today. HCLTech numbers, we'll be reacting to that. Mixed picture, margin was a big miss, but on the revenue front, looks like there is visibility, and in that sense, we'll ask our experts if HCLTech is better poised when it comes to the large cap IT names. Tesla will be opening its India showroom as well today, so watch out for automakers. There could be a sentimental impact in trade, and of course, those were all the stocks to watch out for. But your queries will also be watched out for, so keep them coming in on a live feed. We'll get them addressed by our experts on the show. Gift Nifty hinting at a mildly higher start, but in the pre-open, we can see some red ticks once again. Mixed in the pre-open. Let's see how things open up at 9:15. But quickly take a look at the top headlines before we get on board our experts for the day. Wall Street ends higher, marginally higher rather, even as Trump threatens higher tariffs on more countries over the weekend. Asian markets mixed as investors digest key China data. China's second quarter GDP data comes in 5.2%, higher than expectations of 5.1%. Gift Nifty was indicating a muted open, and in the pre-open we can see a mixed picture right now. Crude oil prices lower amid possible sanctions on Russian exports from US President Donald Trump. Gold prices meanwhile also fall after hitting a 3-week high as focus shifts to trade talks and US economic data. US President Donald Trump announces new weapons for Ukraine and threatens sanctions on buyers of Russian exports unless Russia agrees to a peace deal within 50 days. India's retail inflation cools to 2.1% in June, marking the lowest year-on-year print since January 2019, helped by a sharp fall in food prices, especially vegetables and pulses. Rural inflation softened more than urban. And global EV giant Tesla is ready to enter the Indian market as the company will formally open its first showroom today at 10:30 a.m. in Bandra Kurla complex in Mumbai. The company is expected to showcase 3 models, the Model 3, Model Y and Model X SUV. Well, those were all the top headlines, but quickly take a look at the cues. Wrapping up yesterday's market action, we ended mixed. Broader markets outperformed with strength in both mid and small cap indices, but the good part is that the Nifty managed to defend that 25,000 level on the downside. One thing to note is that even though the Nifty has been managing to defend crucial levels on the downside, we have seen any bounce has been sold into, so it's not even being able to sustain higher levels. But yes, it is trading below key short-term moving averages. But 25,000, if that breaks, I don't know, 24,900 becomes the next support in that sense. But advanced decline ratio also improved in the second half yesterday, almost 1:1. The Nifty Bank Index also did well to recoup most of the intraday losses and end marginally in the green. But IT sector remains the top sectoral laggard. Last week as well, IT was among the top laggards, and yesterday as well, it was extending its losses. Realty managed to stage a good comeback yesterday. It was up in excess of 1%. You had some new age companies like Eternal seeing healthy buying. In fact, Eternal was the top Nifty gainer yesterday, and Hindustan Zinc deserves mention given the fact that MCX Silver hit record highs. Hindustan Zinc shares were in focus and they were moving higher, but Ola Electric That stock surged 20%, highest single day volumes post Q1 results. That's because the numbers were good on a quarter-on-quarter basis, and the guidance coming in from the company was fairly strong. Free cash flow guidance also was pretty strong, which is why the stock was rallying. In fact, it recovered very smartly from its lows. Foreign investors were net sellers to the tune of 1600 crore rupees. In the cash market, DII buying support continues. Almost 1800 crore rupees worth of equities were bought in the cash market. I think in the F&O market, short positions are being added by FIIs as well. Put call ratio declined further to 0.72 vis-a-vis 0.76 in the previous session. And if you look at the stocks that will be in F&O ban, no new additions or deletions, but a few stocks will remain in F&O ban, the likes of Glenmark Pharma, Hindustan Copper, as well as RBL Bank. But on that note, quickly bring on board our technical expert for today. Joining me is Ajit Mishra, Senior VP Technical Research at Religare Broking. Ajit, lovely chatting with you. Tuesday morning, cues are mixed, but 25,000 still on the charts, so we'll take heart from that. But what are you sensing? Do you think we'll slip below that crucial level today, or are we going to be able to defend that once again like we did yesterday?
Yeah, good morning, Nandita. So, Nandita, yes, means last week it was a damage to the structure in which we were already trading in, means a decisive recovery trend and more of time-wise correction. But the last two trading session of the last week and the extension of the same with starting of this week indicates that the kind of momentum that we were seeing in the market that has fizzled out. Means we have slipped below the 20 EMA, which was placed around 25 to 80 area, and the zone means the consolidation range that earlier we were trading in for almost 4 or 5 weeks, means 25 200, 24 500. We have re-entered into that zone. So yes, 25,000, 24,900 is a strong support area, and yesterday Nifty could manage to defend that area. But I believe that it's likely to be consolidation more with a negative bias, after this break of 20 EMA. So until, let's say, we reclaim 25 to 50, one should not be outrightly bullish or look for excessive or recovery opportunity or rebound opportunities. In fact, a recovery towards 25 to 50 would considered as a shorting opportunity in the index, with 24,900 being the target zone. So as of now, the bias has shifted from positive to sideways to negative. And the only silver lining is that banking is still holding strong. So we have to wait and watch, because we have key results over the weekend for HDFC and ICICI. By IT is not helping in any ways. In fact, it is pushing the index lower almost at the month low.
So yes, the earnings season has kicked off on a bleak note, but banking, as you mentioned, is being is managing to hold out. But if you look at the bank index per se, we are below 57,000 levels. That was being looked upon as a crucial level. But now that we are below that level, would you be working with 56,500, or would you say that that yesterday the fact that Bank Nifty made a good recovery from intraday lows, does it make it well poised to extend those gains in today's session?
So yes, in fact, Nandita, still on the banking index, we are holding 20 EMA, which is important. Means on the intraday basis, we breached that mark for brief. We on the closing, we managed to hold that area. So as of now, yes, 56,500, 56,300 is a zone basically where we have multiple supports in the banking index. But since we are seeing mixed trend within the private banking heavyweights, means ICICI, HDFC, they all are witnessing some bit of a profit taking. Kotak is also witnessing a similar kind of attraction. So in such a scenario, only PSU is helping the index. So it can't be outrightly a bullish momentum in the banking space with PSU holding ground. So we need to see whether the private banking majors also start participating and witness some traction. But as of now, it looks like sideways to me with this comparatively better structure than the Nifty index.
Okay, taking your point. Since we are talking about banks, couple of banking names in our query section. I think Varsha Gajjar wants to know your thoughts on HDFC Bank. Axis Bank reports numbers tomorrow, and as you mentioned, the likes of HDFC, ICICI will also come out of the weekend. What's your positioning on these three stocks ahead of earnings?
So, see, HDFC, ICICI, they all are holding around their record highs. Means, yes, we are seeing consolidation after every recovery attempt, but as long as they are maintaining the positive tone and witnesses, more of time-wise correction, it is okay. So, for HDFC particularly, we are seeing this 1940, 1960 zone acting as an immediate support. So, very short term, in case if the view is, let's say, for a day or two before the earnings, then that should be the stop loss. Obviously, earning triggers volatility. So the stop loss should be deeper around 1940 area. So with that as the stop loss, one can continue to stay put. Because once we, let's say, cross this 2020 barrier in HDFC, we can see the stock inching towards a newer highs. ICICI looks comparatively weaker than the HDFC Bank. So 1400 to 1470 is broadly the range. We are closer to the lower band, so that gives us comfort that there could be an attempt of recovery. But as of now, if somebody has to prefer among these two, I feel that HDFC is a better bet.
Okay, HDFC rather is a better bet. I hope that answers your query, Varsha. We'll take up more queries as we go along the show. But just about a minute to go for the market to open. I want to get in your recommendations first, Ajit, for the day.
Right. So defensives means FMCG, pharma. After a long underperformance, specifically in the FMCG, we are seeing sustained buying interest now. And among all the majors, ITC have started forming a base. So where the risk reward is favorable and a potential of strong up move seems high. So with stop at 410, one can buy ITC at current levels with 436 as a target area. And then we have from the healthcare basket, Max Health. After the marginal retracement from its record high area, it again rebounded strongly in yesterday's trade, and we expect this to build further in sessions to come. So 1350 is what we are eyeing in Max Healthcare. Here you can also go long with 1210 as a stop loss.
Okay, those were the recommendations, and we're getting the first ticks, and it is a green tick. So we'll take heart from the fact that we are seeing a 60-point up move. On the Nifty, it's a 170-point up move on the Sensex mid-cap index, extending its gains from yesterday. A 0.5% gain there, and the Bank Nifty as well has started the day with the positive bias. The advance decline ratio at the current juncture almost 3:1, 1160 advances to 408 declines. So right now it looks fairly okay. Fairly positive, so to say. If we manage to maintain this momentum and get in a positive close, that will be heartening because we've seen 4 straight days of losses on the benchmarks. Let's take a look at some of the sectors then that are taking the lead at the current juncture. We can see the Nifty PSU Bank Index up by 0.5%. The metal index up 0.4%. Of course, it is also reacting to the strong Chinese data in terms of industrial and GDP growth. It's reacting to that, 0.4% kind of gain on the Nifty metal index. Even IT index has snapped out of its recent string of losses. It's up 0.2%. All the sectors are trading in the green. So it's an all round, buying kind of a scene right now. Let's hope this momentum continues. Auto pack is also up 0.3%. Realty up 0.5%, extending gains from yesterday. So, good positive start. Just let's see what some of the individual stocks are doing. Sun Pharma, early launch of an anti-balding drug. Now, this comes as a positive for the stock because the stock is up somewhere around 1.5%. You have Tech Mahindra, that's among the top Nifty gainers. Yesterday, it was among the top Nifty laggards. So, some buying emerging at lower levels when it comes to technology names. Infosys as well, trading in the green. Just want to see what HCLTech is doing because, HCLTech is down 0.5% among the top Nifty laggards. Margins were a big miss, but in terms of revenues, better placed or the performance looked better compared to TCS. Eternal under a spot of bother after its recent string of gains. Ultratech Cement, Cipla, SBI Life, ICICI Bank and Titan. These are some of the losers, and the losers list is pretty slim this morning. That's also another positive takeaway. IndusInd Bank, Jio Financial, Grasim, Tata Motors, Eicher Motors, M&M. So all these automakers are, in top gear this morning ahead of the Tesla's India showroom launch. But looking at the open, let's talk about the tech names first, Ajit. Some buying emerging after sessions of sell-off. Anything that you like? Because HCLTech isn't reacting very positively to its numbers. It was a big miss on the margins. Perhaps Street is focusing more on that. But chartically, if you put all four together, HCLTech, Infosys, TCS, etc., which one would catch your eye?
So Nandita, so far, last month it was recovery for IT index almost 4%, and this month so far we have almost retraced the entire gains. So IT majors are basically not helping in any ways. In fact, so far only Infosys is something that where we have not seen any major cut yet. Maybe market is anticipating that they might come out with the better numbers. But still, the upside seems capped. So all the IT majors, be it TCS, HCLTech, and Infosys, short-term bias looks sideways to negative. But among all these names, if the view is, let's say, for 6 months to a year, HCLTech definitely is the better bet, considering its past outperformance and possibility of, stability or on a base formation around 1500 marks, so which is 18 points down from the current area. So if somebody is having a view, let's say for 6 months to a year, they can start accumulating HCL around 1500 mark.
Okay, start accumulating HCLTech around the 1500 mark. In terms of guidance, just want to point out that revenue growth guidance, the lower end of the guidance has been raised to 3% from 2%. So the FY26 revenue guidance is now 3 to 5% vis-a-vis 2 to 5% earlier, and EBIT margin guidance has been scaled down from 18 to 19% to 17 to 18%. Perhaps the street is focusing more on that, and which is why the stock is down and among the top Nifty laggards. But the management has also said that two large deals that were expected to close in Q1 were delayed due to procedural reasons, but they are now likely to conclude within July. So that impact will be felt in the second quarter as well. But we've had some mixed views from brokerages. We have had upgrades as well, and one downgrade as well. Jefferies has upgraded the stock, and I think it's Nuvama that has downgraded the stock. But let's talk about the next stock. Tata Tech numbers came out. Net profit was down almost 10% on a quarter-on-quarter basis, but it was still better than what the street was anticipating. Revenues slipped over 3%. That was also better than what the street was working with. EBIT margin rather has been at 13.6% vis-a-vis 15.7%. That is something that was below expectations, but the stock is up 2% or so, and we have a Goldman Sachs report on this stock after its numbers. It has maintained a sell call with target price of 560 rupees, implying quite a bit of a downside from current levels. They believe that the first quarter numbers were in line with expectations, although EBITDA margins missed expectations by 80 basis points due to soft core services revenue and negative operating leverage. But a sequential pickup in revenue is expected in the second quarter on improved customer engagement and even onwards June. Tata Tech, any thoughts on this particular chart? Targets here being scaled down to somewhere around 560, 550. What are your own thoughts as to where this stock is headed now on the charts?
So Nandita, since listing, we are seeing that every attempt of recovery, it's usually fizzle out, once the stock reaches to its crucial resistance area. And this time around also it was a similar case, means the stock did witness a rebound towards 800 mark, but it couldn't sustain or surpass the major hurdle around, the long-term averages. And though we are seeing a recovery attempt, but at present I'm still not sure that whether this recovery would unfold into a trend reversal so far. So for those who are sitting on the long side in the stock for now, 695 should be the strict stop loss, because there could be a possibility of recovery attempt once, let's say, we surpass 735 area towards 770, 775. But around that area, again, we might face strong resistance. So fresh buying is definitely something one should avoid. But for those who are playing for a rebound, 695 should be the strict stop.
Okay, that's a view on Tata Tech. But let's also talk about Ola Electric. The stock is up in excess of 20% in the last 2 days. Today as well, it's extending its gains. It hit a fresh low as well, and it's quite a while away from its IPO price of 76. But almost around that 50 level, is this a massive trend reversal on the charts? And is this a good buy at the current juncture after the recovery?
So Nanta, in fact, I believe that a lot of retail clients would have been stuck in this stock since the trend has been gradually down. Means as I can see from the record highs of around 157 to roughly around 40 levels. So yesterday was the first day of decisive buying interest. Means the volumes were almost 6 times, 7 times of the average volumes, roughly around 60 crores is something that we witnessed yesterday. So no doubt there could be a recovery attempt where the stock might inch toward 52, 53 area. So very short term, yes, you can continue to hold. Now your stop should be at 43. Yeah. So but risk reward is not favorable to be honest, even at current levels. So I would rather sit on sidelines, wait for some confirmation, sustenance above 52 mark, 53 mark. Then only I will consider it for any short term bets.
All right, got your point on Ola Electric. That's the view. But as promised, let's shift focus to our viewer queries then and start with those that we couldn't take up yesterday. I want to take up the first one from Alex. Wants your thoughts on KEC International. He wants to know the major support levels with a time horizon of 1 year in mind. The stock is doing pretty okay today, but in the last 1 month, it hasn't really done anything. It's just about 2% in the negative.
That's true.
It's somewhere in the mid level between 52-week high and 52-week low. So what is the kind of support one should watch out for the next 1 year?
So Nandita, after this slide from 1300 to 600, the stock has rebounded and now we're in the middle of that range. I believe that 650, where we have the long-term averages placed, if the view is, let's say, for long-term, that's the major area where one should be, again, may see buying interest emerging. At the same time, immediate around 780, also we believe that, the stock might find buyers in case if there will be any further dip. So as of now, 780 should be the area where one should maintain stop. And let's say once we cross 950 area, then definitely, this level around 750 can be cemented for the entire year, because in that case, the stock might attempt a recovery towards its record highs. So as of now, 780 first support, 650 major.
Okay, those are the levels. I hope you've taken note of them. Next query from Debu K. Wants to know your thoughts on Gravita India for an investment purpose. The stock has not had a very great run. If you look at the YTD performance, down 20%. Last 1 month, it has flattened out. So, is it a good time to take a positional view on this particular stock at 1736?
Yes, Nanda, it's been a very strong performer in past. Means if you see that from 2021, roughly around 200 to 2600 kind of a journey, it's natural for the stock to spend some time in corrective or profit taking phase, and that is what we are seeing in the stock for almost 1.5 years now. So outrightly, I won't recommend buying. Means one should gradually accumulate. Means the zone close to around 17, rather 1600 to 1500 zone is the best area to look for accumulation with a time horizon of for a year or more than that. And upside, once let's say we cross 2100 mark barrier, then we'll see the fresh leg of momentum. So as of now, one should refrain from any fresh position, wait for any dip around 1600, 1500 zone, and then accumulate.
Okay. All right, that's the view. Accumulate around 1600 zones. That's the call. Hope that answers your query. Let's take up a query on Bharti Airtel. Komal Makecha wants to know your thoughts. When is the right time to enter this stock for the long term? The stock has been a good performer. Just come under some bit of consolidation, but still very close to its 52-week highs. Is this a good time to buy, or would you advise someone to wait it out a bit before getting into the stock at these levels?
So see, the view is long term, then one should definitely wait because as you rightly mentioned that again here also we were seeing almost outrightly very bullish steady uptrend, and finally we have started seeing some bit of a profit taking, decisive profit taking, especially in the last week. In the range of roughly around 1750 to 1800 could be the zone where we might see the stock finding strong buying interest. So one should wait for that area if the view is let's say long term. For short term, traders, in case if you have any existing position, 1890. That should be the stop, and use any recovery around the 1950, 1960 area to reduce your positions.
Okay, that's the view on Bharti Airtel. Hope that helps. Let's take up a query on the defense pack. Bharat Electronics, to be precise. Kartikeya Singh wants to know what should be done with this stock during this correction phase. What are the levels that can be added for the long term? The stock is still near about its 52-week highs. How do you navigate these stocks now? Because they've once again started consolidating, but for Bharat Electronics in particular, it's still near about its 52-week highs. Risk reward wise, how are you viewing some of these names?
So Nanda, if you see the defense basket, in fact, last week we've shared an update with our clients that the index has been experiencing more of distribution trend, and that's the reason why we've recommended to reduce their position, long position in the defense counters, including BEL, if the view is short term. So we reiterate that view that after this strong outperformance, we may see consolidation of profit taking, including in BEL. But yes, as you have rightly mentioned, it's still among the top performing name within the defense basket. So comparatively, the downside seems capped. So maybe around 390, 380 area. There we might see a first leg of buying interest emerging. But since the view is long term, one should wait for any decisive consolidation. Because from roughly around 240 to around 420, it was almost a vertical rise. So let the stock consolidate a bit before you make any fresh bet, even for the long terms.
Okay, that's the call, Kartikeya. Let the stock consolidate and then perhaps take a call. But 380, 390, that's the one level that Ajit really mentioned on the stock. Last couple of queries then. Want to take up this one on L&T from Satish Guntur. What do you do with the likes of an L&T that's just been stuck in a range? It refuses to move out. If you look at the long-term charts, not even long-term, medium-term, 6-month kind of charts, the stock hasn't gone anywhere. How do you approach this particular counter?
So yes, Nandita, see, when it comes to certain stocks, they are proxy to the infra space, and still, if you when it comes to trading, yes, it's important that you should stick with the quality names. But if those names are under consolidation or witnessing a range bound move, like what we were experiencing in HDFC some time back, so there's no point arguing with the market. So in case if the view is short term, definitely you should avoid it. And until we, let's say, break this 3750 area, you can write it down in your notebook or you can put an alert. Until we break that mark, I doubt that we can see any meaningful, strong or decisive recovery in the stock. Downside also seems capped, so close around 3400 is something that we may see as a immediate support. So for an investor, it's basically the time where one can look to accumulate on dips. But for a trader, it's definitely a big no that until we break this upper hurdle.
Okay, so those are the levels, and basically untouchable unless we break below that particular level. Last query then, I'm getting one on Piramal Pharma. This is coming in from Gurpreet Singh. Hasn't really sent in a pointed query, but any thoughts? The stock is seeing good traction. Has seen a good up move in the last month or so. Recovering, so to say, because last 6 months it has given negative returns. Within the pharma basket, does it catch your eye, Piramal Pharma?
So we started seeing some traction of late. And that means the stock has reclaimed its short-term averages, long-term averages now, and the volumes are also okay. So yes, if the view is very short-term, one can look for a trading position with 225, 230 as a positional target and 195 as a stop. But in case if somebody is looking for a better alternative, then Wokhard, Star, Biocon, these are the better names within the pharma basket where one can look at.
Okay, that's the view on some of these pharma names. Hope that answers your query. You have better names within the pharma basket to look at. But with that, we've come to the end of the query segment. If you couldn't take up your queries today, well, we'll take it tomorrow. But Ajit, I would like to thank you for taking our time and joining in and sharing your thoughts. Always a pleasure, and I look forward to our next interaction as well.
Same here, Nandita. Thank you. Thanks a lot.
Thanks a lot. Have a great day.
Same to you.
Well, we are holding on to the opening gains, 25,130 on the charts when it comes to the Nifty. A cool 150 point up move on the Sensex as well. Mid cap index continues to build on the gain that we saw yesterday, another 0.5% up move. Breadth is solid, almost 4:1 on the NSE, so nothing to complain. And the list of gainers is longer than the list of losers, so that's another thing that one should take heart from. But lots of result reactions, lots of stocks in focus. Let's put the spotlight on some of them. Joining me right now is Siddhartha Khemka, Head of Research Wealth Management at Motilal Oswal Financial Services. Siddhartha, lovely chatting with you. While the markets have been able to defend the lower levels, hasn't really been able to sustain higher levels. We are ranged, so to say, but the range is now becoming wider with more bias towards downside. But let's put the spotlight on earnings and some stocks that have been hogging the limelight, starting with HCLTech. We all know TCS started FY26 on a bleak note. Commentary was cautious. Dollar revenue, CC revenue rather, constant currency revenue growth, faltered 3.3% down. That was, very bleak starts, so to say. But would you take heart from the fact that there is some bit of revenue visibility when it comes to HCLTech, although margins were a big disappointment? How would you compare, and do you think HCLTech is the better placed after earnings within the large cap pack?
Good morning, Nandita. Yes, glad to be on the show early morning. So I think if you look at the IT earnings, even Q4 was a mixed quarter. We saw weak commentary from TCS and Wipro, and bearing these two others were quite a bit, you can say, in terms of the long-term outlook optimistic. And HCL Tech does that. The revenue growth has been in line to better than expectation. What we have seen is that higher spends, especially on the Gen AI and the newer businesses, that is leading to some margin correction and dip in the margin, and hence the net profit is little bit below expectation. But what the company has done is that it has upgraded the bottom end of the revenue guidance. And even if you look at the discretionary demand in the financial services, high tech, that is looking out. The management committee says that a recovery into the discretionary spend, especially in the financial high tech services, are looking like a recovery in the near term. Weakness is continuing in the manufacturing, life science, and retail segment. So I think if you look at something like an HCL Tech, 1 or 2 quarters, they would get the impact of higher spending in the newer businesses, the Gen AI, and also the spending on the sales, SGA investments. But that could lead to improvement in growth in the latter half of the year, and more specifically in FY27. Valuation wise, pretty comfortable. I think Within the overall IT pack, we are expecting a very steady, stable numbers from HCLTech. We are expecting 7% currency dollar revenue and about 9% PAT growth over the next 2 years. It is one of the faster growing large cap IT companies, and given its diversified portfolio, it remains an all-weather IT stock. As I said, in the near term, there will definitely be some pressure, but something from a long term, HCL Tech is our top pick within the IT space.
So when do you expect margins to normalize? Because they have scaled down the margin guidance by 100 basis points, right? Would you expect that to happen this financial year itself, or would it take a couple of financial years, or FY27 would be the year when margins would normalize? What is your take on that?
Definitely, I think, as I said, 1 or 2 more quarters of higher spending could impact margins. We are expecting, so FY27, we are largely keeping our estimates unchanged. We believe FY27, HCL Tech margins can get back to the normalized level of 18.5%. So for FY26, we are forecasting an EBIT margin of 17.8%, which is down from 18.3% in the last year. And then we are again forecasting the margins to improve back to 18.2% in FY27. So I think towards the later half, at least I think Q3, Q4 onwards, we'll see the uptrend or improvement trend in margins.
Okay, got your point. You mentioned that valuation-wise, things are comfortable when it comes to the likes of HCL Tech. But what about the mid-cap IT basket? Valuations there may be a little more elevated. But given the fact that there is a promise of double-digit growth there, would it be okay to pay that kind of a price for mid-cap IT? And if yes, which is the stock that you guys like at Motilal Oswal?
Yeah, I think, as you rightly said, some of the mid-cap IT companies, they are trading at a higher valuation. If you look at something like a Coforge, it is trading at almost 30 times on a 1 year forward FY27 compared to HCL Tech, which is trading at about 21, 22 times. Even the likes of TCS, which used to trade at a premium valuation, is now down to about 21, 22 times on a forward earnings, but obviously with the growth coming down. So what we believe is that with a strong earnings growth in excess of 20-25% growth that we are expecting for something like a Coforge, Persistent, we believe that the current valuations of about 30 times is still comfortable. Both Coforge as well as Persistent, given they're already invested in the new age Gen AI capabilities, the growth is pretty strong. So for the growth in the entire pack, we believe valuations are justified. We see at least 20-25% upside in both Coforge as well as Persistent. We have a target price of 7,000 on Persistent. Coforge, we have a target price of 2,400. So definitely, I think if one is looking at the IT, mid-cap IT with a strong growth is the place to be with.
Okay, Coforge and Persistent looking good despite elevated valuations in the mid-cap IT space. But let's shift focus to pharma. We know that the Revlimid, sales tapers off for pharma, right? The big pharma from January 2026. But now, some good news when it comes to Sun Pharma. It has launched its anti-baldness drug Leqselvi in the US earlier than anticipated. Now, according to Morgan Stanley, sales are projected at over 61 million for FY26 and over 80 million for FY27. How much of an earnings boost are you penciling in for FY26 from this particular drug? Also, will it be able to plug the Revlimid gap? Your thoughts?
I think if you look at the overall, first on the pharma space, we have seen last 13 quarters of consistent healthy performance from the pharma sector. Finally, we are seeing the base catching up, and this quarter we are expecting our entire pharma healthcare coverage universe to report a modest 5% EBITDA growth. So definitely, if you look at, there is some moderation in the domestic formulation segment, which used to be pretty strong. Hospitals is something again where we are seeing strong growth. led by strong execution, bed addition, and we are expecting a 20% growth in EBITDA. I think the US generic companies there is definitely some pressure that continues, and we are expecting the US generic coverage revenue to contract after 11 quarters of expansion, and we are expecting a 4.4% decline. There are definitely some of the products which will get impacted, especially as you rightly said for Sun Pharma. The numbers that we are forecasting that even Q4 there was a miss. This quarter there could be a slight decline, especially in the US generic business. What is comforting is that valuations have also come off, and with the lesser probability of a US tariff, which has been talked about several times, that our special tariff on pharma could be imposed. It looks like it's unlikely to happen, and there is some kind of deal in the works for, especially for the Indian pharma exports to US. So I think it's definitely a contra play right here to look at some of the generic pharma names like a Sun Pharma or a Cipla or a Dr. Reddy's. Again, if you look at the oral pharma space, CDMO is something that continues to report strong numbers. Companies like Divi's, Laurus, there we would see strong earnings growth in Q1.
Okay, that's about pharma. We need to have a bigger discussion once the pharma tariffs come into play. That of course Trump has threatened time and over and over again. Actually, fourth time, last time when he said that never seen before 200% tariff on pharma. That's one pocket that will be in focus. But perhaps another day. But let's talk about some other sectors then. Want to talk about the gas space, so to say, the city gas distribution space. This morning there were some flashes. PNGRB, the regulator, has flagged irregularities in domestic PNG pricing and wants uniform rates across consumption levels. Now, if there is a clampdown on telescopic pricing, how much of a hit would margins take for these city gas distribution companies like IGL and MGL in particular?
Nandita, if you look at the city gas distribution, the domestic gas companies are highly regulated, both the marketing margins and the entire pricing that is being controlled. And despite that, some of these companies have reported strong growth. So we believe that while there could be some impact if this comes in, I'm yet to do the numbers and to come out with the exact impact. But what we see that recently we saw we have upgraded the sector mainly on back of the steady volume growth, scope for margin expansion, as well as reasonable valuations. We believe that CNG can be one of the fastest growing engine types in India that has been continuously growing. At least we saw 35% growth in FY25 and is now a sizable portion of the overall auto OEMs. CNG market share in the overall industry is expected to continue to rise in the medium term. And given that the penetration for CNG in the automotive sector continues to do well, the city gas distribution is also something where the growth is improving on a gradual basis. So yes, today's news, I think definitely a negative concern, but any correction could be a good opportunity to buy into companies like Mahanagar Gas, Gujarat Gas, Indraprastha Gas. So we like all three gas companies. We have a target price of about 1760 for Mahanagar Gas. Gujarat Gas, we have a target of 535, and Indraprastha Gas, we have a target of 230.
Okay, a bullish view coming in on the city gas distribution names, and those were the targets. Hope viewers, you've taken note of them. But let's shift focus to the auto space. The space has been buzzing, and today, of course, we have the Tesla's India showroom rollout as well. But let's talk about Ola Electric first. Numbers came out sequentially, good performance. They've given a solid guidance. They've said that the auto business should generate free cash flows by the exit of FY26. Music to the ears for investors. The stock has done well in the last couple of sessions. It has a lot of catch up to do when it comes to IPO price of 76 rupees. But, time to get constructive.
So, Nandita, I think mixed views right now. This is the first quarter where things are looking a bit better. So definitely music for the investors who have been struggling in Ola for last since listing, I would say. But there is still a long way to the path to profitability. I think there is a huge competition going up. Ola has been losing market share in its core business, the two-wheelers, where we have seen last couple of quarters, some of the uh, erstwhile companies, for example, previous motors have gained significant market share. Bajaj Auto, with its launch of Chetak EVs, two-wheelers have gained significant market share. In fact, I think that a major concern for Ola has been the serviceability and the reliability of its products, where consumers are ditching Ola for some of the known brands which have a service centers, which have given them peace of mind. So I think definitely the commentaries for the commentary coming out from the management about generating cash flows, turning EBITDA positive should be taken as a positive. But I think there is few more quarters where we need to see consistent, at least if you see the market share consistently, they can safeguard their market shares and then gradually improve. That could be a key factor going forward. One of the business that definitely looks interesting is the battery business, where they have recently set up the large EV battery plant. I think that could be a good growth driver for Ola going forward.
Okay, we'll have to see whether this is the turnaround quarter that the company was waiting for, and if it builds on that, and that's near term. In fact, that's a monitorable for the stock. But staying with the auto space, as I mentioned, Tesla is launching its Mumbai showroom in BKC today. How worried should players like M&M, Tata Motors, Maruti be? Because the cheapest Tesla model would cost somewhere around 29 lakhs, while the average price for most mass market cars are around 11 lakh. So would the impact be fairly limited, and are competition fears overstated? Because Friday we saw the stocks reacting negatively, but today they are doing fairly okay in trade.
So I think, Nandita, the Indian EV space is just opening up. We saw how the Chinese EV players penetrated globally and took a lot of market share. So even in India, we saw BYD getting in, gaining a lot of share. So as you rightly said, Tesla's launch will be in the premium segment, while if you look at something like the largest four-wheeler EV in India, Tata Motors, their brand Nexon, I think that is in the 11, 12 lakh range, and there's no comparison or competition with the likes. So some of the players like Hyundai or some of the premium segments there could be some competition initially, but I think there is enough room for all to grow in the EV four-wheeler space. That is a market that is just opening up to see a lot more brands. Thankfully, some of the Indian companies are ahead in terms of launching. For example, Mahindra has launched a slew of EVs. I think very strong demand there. So it's more about talking points right now rather than an actual impact. Definitely need to see how the market reacts to it. But I would say that it would only open up the overall, you can say the EV environment for India, with more players coming in, the infrastructure being set up, and the market being more aware for the EV space.
Okay, that's about autos. But last question really. We have banking numbers that we are waiting for. Axis Bank kickstarts the earnings season for the banking pack tomorrow. Aside of margin pressure, what is it that you will be watching out for? Which is that private sector bank that you are betting on now?
So definitely, I think a lot is expected out of banking, but clearly we are seeing that the credit growth has remained kind of subdued, with a systematic credit growth at about 10% till the mid of June. What is heartening is that deposits growth has seen significant growth, which has been a major pain point for some of the banks in the last couple of years. So we expect NIMs to reduce marginally on an overall basis, but I think with the RBI liquidity push, the CRR and the repo rate cut, the overall environment looks pretty steady. So, for example, for the private banking space, we are expecting the pre-operating profit to grow about 4% on a Y-on-Y basis, while the public sector banks we are expecting also growth to moderate to about 5 odd percent. What we look out for, ICICI Bank, I think, has sustained a strong growth momentum in the past few quarters and even last few years. I think NIMS could surprise positively. Even Q4, it rose about 16 basis points compared to the overall expectation of NIM being flattened for their sector. So that's the top bank that we will look out for. HDFC, again, as I said, continues to focus strongly on the deposits post the merger. There was a big gap between the credit growth as well as the deposits, and the last 2 quarters they have focused a lot on deposits. Hence, again, that led to some improvement in NIMS. Even in Q4, we are expecting a stable to marginal improvement in NIMS going forward. So, with margins normalization, improved asset quality, and the strategic rebalancing, we believe HDFC Bank could be the other one for to look out for in the Q1 numbers.
Okay, that's the view. ICICI Bank, could perhaps surprise on the margin side, and HDFC Bank, of course, recovering post the merger. But any thoughts, any closing thoughts as to where we expect the markets to head from here? Because even the mini US trade deal is still taking shape. With the Commerce Ministry team in US for a 4-day chat over the contours of the deal. That's yet to be announced, and there's some we are still lacking clarity on that front. And here we have Trump rolling out higher numbers when it comes to tariffs for other nations. So how are you approaching the market? What are your thoughts? Do you think the downside is limited from here, or do you think earnings will play a big role in deciding whether 25,000 levels can be defended here on? Your thoughts on where we are really headed from here now?
So definitely, Nandita, I think the question that everyone in the street is talking about is when and how and what form the mini trade deal with US will come by. And I think that could be a big trigger for the market, which it is waiting for. In the interim, I think while the global markets are reaching new highs, Indian markets have shown maturity and have kind of consolidated in the last, you can say, last 1 month. We are hovering up between the 25,500 odd zone, but clearly looks like downside is limited. The worst in terms of earnings is done away with. We are seeing Q1 FY26 as a crossover quarter. We are expecting things to improve from here on. A, base effect. B, we are seeing some of the domestic sector demand improving. Plus, you have the RBI doing a lot of liquidity boost, which should help some of the financials, some of the NBFCs, plus improve demand in the overall sector. Plus you also had the government capex spending on an overdrive. April and May, we saw the government capex at very strong growth on a Y-on-Y basis. Obviously, last year we saw a lot of postponement because of the elections, but this time government is taking no chances and is front loading the capex. So a lot of positives in the in the earnings, I would say. In terms of overall market, as I said, we are expecting a consolidation and only a fresh move once the deal with US is announced. If not, if we suppose the worst case scenario is we get a letter from Donald Trump, that could lead to some downside. But in terms of sector quarterly earnings, that will definitely lead to a lot of sectoral and broader markets stock picks. So expecting sector and stock specific action led by the quarterly results, plus a lot of domestic factors, macros, monsoon being pretty positive. So once the deal is announced, I think market could take out the previous highs and reach new highs.
Sure, the mini deal, that will be the key factor. But, tell me one thing lastly, markets were getting comfortable with 10%, but are we really prepared, or is a rate higher than 10-15% in the price, or do you think that could lead to a bigger correction?
No, Nandita, I think market is still waiting, and I think a 10% is definitely in the price. Anything higher than that will lead to a knee-jerk reaction. But again, as I said, a lot of sectoral impact is there for India. The key points for India is, I think, the agriculture inputs that US wants to export to India. I think some of those things, pharma as a space that we are trying to do a deal. So a lot of sectoral numbers will come into play, but a number higher than 10% could lead to a knee-jerk reaction on a negative side.
Okay, yes, a number higher than 10% would lead to a knee-jerk reaction on the negative side. Perhaps that's when that could be a key risk actually for the market going forward. But with that, Siddharth, would like to thank you for taking out time and putting things into perspective for us. Look forward to more chats as the earnings season continues, and we'll touch base. Lots of sectors, lots of stocks will be in focus. So would love to have you back on the show.
Thank you.
Thanks a lot. On that note, take a look at the market. We've kind of fizzled out from the opening highs, but still 25,100, stays. So let's hope we manage to, defend that level as well. And the Sensex is up somewhere around 80 points or so. The mid-cap index has also kind of fizzled out from opening highs. It's just about 0.1% higher as we speak. The breadth is still, although skewed firmly in favor of gainers, almost 5:2. That's the NSE advanced decline ratio as we speak. Top laggard HCLTech on the back of margin disappointment, and the likes of Tata Steel, Cipla, JSW Steel, Tech Mahindra, Ultratech. These are the laggards. On the higher side, we have some two-wheeler names like Hero Moto doing well. Eicher Motors also among top gainers today. SBI, PSU banks, taking the lead. Sun Pharma, some private banking names like Kotak Mahindra Bank also doing well, and so is Bharti Airtel and Reliance Industries as well. But with that, completely timed out on this edition of Opening Bell. Thanks a lot for tuning in. 10:30 is when the Tesla showroom in Mumbai, that's the launch time, and of course watch out for that. And of course, stay tuned to Money Control for all your other news and updates. I'll see you at 3:30 p.m. with closing bell. Don't forget to tune in then. Thank you for watching.